Have you ever wondered how cities can transform vacant spaces into thriving communities? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The city has chosen a developer to spearhead a significant $48 million project aimed at revitalizing 2 acres of vacant land in the Roseland area on the far south side. This project is set to bring much-needed affordable housing and retail space to the community, marking a transformative step for the city-owned land. The development, named 115 at Michigan Station, is a mixed-use initiative that seeks to breathe new life into the neighborhood. The Chicago Department of Planning and Development is heavily involved in this effort, ensuring that the project aligns with the city's vision for sustainable and community-focused urban development. This endeavor isn't just about construction. It's about creating opportunities and enhancing the quality of life for residents in the area. By integrating retail spaces with affordable housing, the project aims to create a vibrant, interconnected community that can support local businesses and foster economic growth. Comparatively, if we look at the Kitchener-Waterloo region in Ontario, similar initiatives are underway to utilize vacant spaces for multifamily housing developments. These projects not only address housing shortages, but also contribute to the economic vitality of the region by attracting new residents and businesses. In the United States, such projects are increasingly common as cities seek to maximize the potential of underutilized lands. They represent a broader trend towards mixed-use developments that combine residential, retail, and sometimes even office spaces to create dynamic urban environments. According to new research from CBRE, the United States multifamily housing market is showing strong signs of recovery as robust demand outpaces new supply, driving vacancy rates lower and fueling investor confidence. In the first quarter of 2025, the sector posted a net absorption of 100,600 units, the highest first-quarter performance since the year 2000 and more than 3 times the pre-pandemic average. This marks the 4th straight quarter in which tenant demand has exceeded the number of new units completed. As a result, the national multifamily vacancy rate fell by 20 basis points to 4.8%, dipping below its long-term average of 5%. The surge in demand comes amid a slowdown in new construction. Following a record-setting 450,000 new units delivered in 2024, only 70,600 were brought online in the first quarter of 2025. CBRE expects this deceleration in completions to persist throughout the year. Average monthly rents increased 0.9% year-over-year to $2,184, with rent growth expected to strengthen further due to reduced supply and continued healthy absorption. Investment activity also surged, with multifamily transaction volume reaching $28.8 billion in the first quarter of 2025, a 33% year-over-year increase. The multifamily sector captured the largest share of commercial real estate investment activity for the quarter at 33%. Kelly Carhart, head of multifamily capital markets at CBRE, noted that multifamily fundamentals continue to strengthen due to strong renter demand and a diminishing construction pipeline. She expects the gains to continue this year and accelerate in 2026. While broader economic uncertainty may impact consumer sentiment and capital markets, multifamily remains one of the most resilient asset classes. As the sector transitions from a period of heavy supply to one of more moderate growth, analysts expect continued momentum for multifamily performance through 2025 and into 2026. Additional highlights from the first quarter of 2025 include the Midwest leading the nation in annual rent growth at 3.3%, followed by the Northeast at 2.7% and the Pacific at 0.9%. New York, Atlanta, and Phoenix posted the highest net absorption totals. 63 out of 69 tracked markets recorded positive net absorption, with 49 markets seeing demand exceed new supply, down from 64 in the fourth quarter of 2024. Furthermore, 47 markets experienced a quarter-over-quarter decline in vacancy, compared to 63 in the previous quarter. Phoenix's urban core has experienced a significant transformation in recent years, driven by a boom in high-rise apartment developments. Thousands of new residential units have been introduced to the downtown area, with more projects on the horizon. This surge in construction is reshaping the skyline and contributing to the revitalization of the city's center. The increase in high-rise apartments is part of a larger trend observed in major urban centers across the United States, where cities are focusing on vertical growth to accommodate increasing populations and the demand for urban living. Phoenix, with its expanding economy and attractive lifestyle, is a prime example of this trend, attracting both residents and investors alike. While Phoenix's high-rise boom is noteworthy, similar developments are also occurring in Canadian cities like Kitchener-Waterloo, London, and Cambridge in Ontario. These regions are experiencing a rise in multifamily housing projects aimed at addressing housing shortages and supporting urban density. The parallel growth in both countries highlights a shared focus on sustainable urban development. In Phoenix, the influx of new residential units is expected to have a positive impact on the local economy, creating jobs in construction and related industries, while also attracting new businesses to the area. This aligns with broader urban development goals to create vibrant, interconnected communities that offer a mix of housing, retail, and cultural amenities. In recent news, Cohen & Steers Incorporated has made a significant investment in Hudson Pacific Properties Incorporated, a leading West Coast office real estate investment trust. The $300 million investment was made on behalf of Cohen & Steers clients' accounts, positioning them as a cornerstone investor to support Hudson Pacific Properties' balance sheet recapitalization. This move is a vital step in strengthening Hudson Pacific's financial foundation and enabling it to execute its strategic priorities. The investment by Cohen & Steers reflects 43% of Hudson Pacific Properties' $690 million offering. Victor Coleman, Hudson Pacific's chairman and chief executive officer, expressed satisfaction with the successful closing of this offering, highlighting the importance of this capital in achieving their strategic goals. He noted that the major investment from Cohen & Steers, along with contributions from other investors, signals an improvement in West Coast office fundamentals and the potential benefits of pending state and federal incentives to enhance studio production. Jason Yablon, Executive Vice President and Head of Listed Real Estate for Cohen & Steers, emphasized the confidence in the recovering West Coast office market. He believes this improvement will continue in the coming years. Hudson Pacific's recapitalized balance sheet, along with its high-quality portfolio, positions the company to reduce debt, extend current debt maturities, and capitalize on an impending occupancy increase in the West Coast office market. Earlier this year, Cohen & Steers Income Opportunities Real Estate Investment Trust Incorporated, in partnership with Phillips Edison & Company, acquired Oak Grove Shops, a 142,000 square foot grocery-anchored shopping center in Orlando, Florida. This acquisition was the second for their $300 million joint venture, which focuses on acquiring open-air, grocery-anchored shopping centers. Additionally, in April, Hudson Pacific Properties secured a $475 million commercial mortgage-backed securities loan for a portfolio of 6 West Coast office properties, totaling over 1.4 million square feet. The strategic investments and financial maneuvers by Cohen & Steers and Hudson Pacific Properties underscore the resilience and potential recovery of the office market, particularly on the West Coast. These developments reflect a broader trend of confidence among investors and developers in the commercial real estate sector as they adapt to new market dynamics. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.